Here's a stock from Corey in Vancouver that one of our guests yesterday recommended as a top pick. Go ahead, Corey, with your question.
Oh, thank you for taking my call. I actually purchased Seadrill a while ago and would like to know if it's a good stock going forward. It does have a high capital expenditure. Thank you, and I'll hang up.
Yeah. So oil service is a group that is under pressure because of the weak oil price and certainly gas prices. Seadrill specifically caters to international offshore drillers, and they have a pretty good book of orders. But I would say that you're swimming upstream in the sector. So a lot of these stocks have rallied over the last month after the European ECB came out with their package for Spain. Mm-hmm. I would use that strength as an exit point. I think that it's going to be a sloppy summer for the group. And again, oil prices are backing off. I think that they're likely to be sloppy for a little bit here. The positive on Seadrill is it's more focused on companies that get Brent pricing, which is like $100 a barrel versus 80 some odd for WTI. That's a positive, but the group itself is under pressure.
All right, David, here is Ambrish in Brampton, Ontario. Hi there.
Hi, gentlemen. How are you doing?
Very well. How are you?
Good. David, my question, I got actually two questions. Number one, what do you think about Fastenal, FAST, that's the ticker symbol on New York Stock Exchange? Because after it got split in June last year, it's 2-to-1, it still rallied from 30 up to 53 and went down to about 40. Mm-hmm. And the second question is, what's the correlation between when the equity to debt ratio is 0, the price multiples are very high? What do you think, and what's the reason about it? Thanks. I hang up and listen.
Okay, so two questions. The first question was on Fastenal itself. We actually quite like some of the housing-related stocks. It's a group that's performing pretty well. It's an important group in the U.S. market. And Fastenal had been a leader through the course of the early part of this rally over the last 3 years. Now, in a stock that has very strong price momentum, often as time goes by, and if they continue to execute, it will trade at a very high earnings multiple. If there's any kind of disappointment or concern, then that earnings multiple can be compressed. So even a small change in the earnings estimates can have a big impact on share price. So it's a good company. They execute very well. They've had very good growth. Stocks come from 55 to 40-ish. If the stock was able to stabilize here and trade back through sort of $45 and the group remains strong, it's one that I would take another look at. Right now, there may be other stocks in the group. So that's the first question.
Actually, you know what, let's stick with that one question just to be fair to everybody. Let's move along. We've got Don, who's in Edmonton. Go ahead, Don.
Good afternoon. What do you think of natural gas? Is it a good time to buy any natural gas stocks, or how long you have to wait to buy these natural gas stocks?
Right.
A year out or 2 years from now?
All right. Where do you stand now?
There's a good joke on that, but I don't have time to tell it. The issue that you have is nat gas has been really weak. They're just finding a ton of it through North America using new technologies. The nat gas has had a good bounce in the last little while. There are people who would say, well, maybe it's bottoming. I think probably it's more weather related. We've had some really hot weather in North America that's driven prices up. I think you want to see what happens to the price after the weather breaks, and we seem to be seeing that right now. I think you're early on it still. There's just too much of it, and there's not enough infrastructure to get it to market, and so price is remaining weak. I would be very careful, especially look at the nat gas producers that have hedges that are running out. And lots of them have hedged production, that the hedges start to run out over the next few months. And for instance, in the ones that pay yields, you're going to see distribution cuts. I would still be quite cautious of the group. Maybe later in the year, we'll see something different.
You've got a very low energy exposure, do you not?
I think we are in the kind of market you really have to pick your spots, and you have to understand that investor appetite has shifted from risk to lower risk, from non-yielders to high yielders to dividend growth. So you want to fish in that pond because that's where the investors are. It's a lonely wait right now on things that don't pay a yield.
All right, David, here's an email. This is on Yum Brands. Kelvin wants to know, what's your opinion on Yum based on the European environment, and maybe more specifically, you want to be talking about the Chinese environment of the Yum Brands.
Yum Brands is a great company. It, though, is a very clear play on the Asian consumer. Over 50% of its EBIT now comes from Asia. And with some of the data coming out of Asia, you know, we had weak imports last night. It's showing that there is a slowdown taking place, and they're getting some negative comps in their Asian operations. So at some point, there's going to be another opportunity in Asia. I don't doubt that, and Yum is going to be one that you want to own. I think that you know, if you own the stock, it's sitting right on the 200-day moving average, you probably hold on to it. But I'm not sure it's time yet to buy it.
And you don't hold it?
We don't own it currently. I will buy it back at some point, but I'll probably wait and see some change in the way that Asian securities are behaving. And right now, it's the weakest performing part of the world.
And just lastly, with Yum, did you run it up? Did you ride it up over 70?
We did very well with Yum Brands, as we did with McDonald's, as we did with Starbucks. It's just this has been a group that's in correction recently.
All right, here is Dave. He is in Kelowna, BC. Hi, Dave.
Hi, Mark. David, C&Q hit the 52-week low today, and I think oil's going to hit 75 before it hit 90. Between that and Suncor, which would you, what price would you actually nibble at these two stocks?
Right.
Thank you very much.
So this has been an unpopular one for us because I think the last time I was on, I had to admit that we were short the stock. And in fact, we still are. And it is not a comment on the quality of the business. It's just this is the wrong place to be right now. These have relatively high fixed costs, and you've got weakness in oil price. And the price that they're getting is not WTI. It's somewhere below that because there isn't enough infrastructure. So I think I would still stay away from the CNQ and the Suncor as a group. Again, there may be a great opportunity later in the year, and as a long-term buy and hold, probably it's not a bad investment. It's just not our strategy to pick bottoms in stocks.
And at what price did you short CNQ, and when would you cover it?
At various prices, probably in the mid-30s, and I can't tell you exactly.
Okay.
And again, we run stops, so you know we'll stay short the stock until we get stopped out of our position.
All right, David, we'll take a short break here. More calls and emails on the other side for David Burrows on North American Large Caps.